Now, let's discuss about the case study on capital structure. Another very interesting case study, very easy. So this is on capital structure. Let's try to understand. And these are the kind of case studies which institute has been asking in the exam and they can further ask in the examination. XYZ Industries Limited, a renowned player in the manufacturing sector, has been contemplating an ambitious expansion program. To finance this growth, the company scrutinizes the current capital structure, which is a blend of equity, retained earnings, preference shares, and debentures. So that means in the current capital structure, they have all the four elements, right? They have equity, they have retained earnings, they have preference shares, and they have debentures. This is about the current capital structure. The equity base of XYZ Industries is robust with 40,000 equity shares of valued at rupees 100 each. Right? So these are the number of equity shares given, 40,000 number of equity shares, rupees 100 each, amounting to a substantial 40 lakh rupees. This equity foundation is bolstered by the retained earnings of 10 lakh, reflecting the company's prudent profit reinvestment strategy. So if I talk about the current capital structure, so current capital structure consists of equity. In the current capital structure, they have what? They have equity. Equity is how much? Equity of rupees 40 lakhs. They have retained earnings of 10 lakh rupees. Right, so this is the current capital structure. Let's further see. In addition to the equity the XYZ Industries Limited has diversified the financing through 9% preference shares and 7% debentures, each contributing 25 lakhs to the capital pool. Still, they are talking about the existing capital structure only. So they have 9%. What they have is 9% preference share capital of 25 lakhs and 7% debentures again of 25 lakhs. Right, so this is the current capital structure that they have. Total is 1 crore rupees, isn't it? Total is 1 CR, 40 lakhs plus 10 lakh, 50, 75, 25, yes, 1 CR. This strategic mix of debt and equity showcases the company's balanced approach to leveraging and the risk management. The company's capital yields a healthy return rate of 12% on the capital employed, indicating of its operational efficiency and market competitiveness. Now, what is this given? What is this given, sir? They say the company yields a healthy return rate of 12% on capital employed. What they want to convey by this? Through this, they want to convey that EBIT of the company is 12% of capital employed, right? So this 12% is nothing but the EBIT of the company. However, it operates in a high-tax environment with an income tax rate of 50%, which significantly impacts the net earnings and available reinvestment capital. Faced with a need to raise an additional 25 lakh for its expansion program, XYZ Industries Limited stands at a crossroads. Now they want to raise this additional 25 lakh rupees. The decision to fund this venture will require the careful consideration of the cost of capital, tax implications, and the impact on the shareholder value. The management must evaluate whether to issue more equity shares, preference shares, or debentures. So they have three options for raising this 25 lakh rupees, either through equity shares or preference shares or through debentures. Issuing equity could dilute the current shareholders' value but would not increase the company's debt burden. Preference shares offer a fixed return to the investors and have the priority over equity in profit distribution but come at a higher cost than the debt. Features are given basically. The debentures are less expensive due to the tax deductible interest expense but increase the financial risk of the company. XYZ Industries Limited journey towards expansion is not just about raising the funds but also about maintaining a delicate balance between the growth aspirations and financial stability. The company's choice will set a precedent for its future financial strategies and the market reputation. All this is what? All this is a story. The crux of that story is that either for raising this 25 lakhs of additional amount, you can use either equity shares or preference shares or debt. That's the crux of the story. Is that clear, everyone? Faced with the challenge of capital structure decision making to finance the expansion program, the finance manager is considering the following alternatives: issue of 20,000 equity shares at a premium of rupees 25 per share. Okay, sir, 20,000 new shares will be issued. Issue of 10% preference shares or issue of 8% debentures. For what? They want to raise how much money? They want to raise 25 lakh rupees. For raising this 25 lakh rupees, they have these options, right? The manufacturing company has estimated that the PE ratio in case of equity, preference and debenture financing would be 20, 17 and 16 respectively. You are required to evaluate the various financial alternatives considering three plans proposed as Plan 1 equity, this is Plan 1, Plan 2 preference shares and Plan 3 is debentures, right? So considering this, we have to find out what? We have to find out the amount of profit after tax under the three plans. We have to calculate the total preference dividend under the three plans. And we have to calculate the amount of earnings available for equity shareholders, that is your residual earnings under the three plans. Then you have to find out the EPS under the three plans. You have to find out the market price per share. So what should be done? Think about it. Capital structure. You need to calculate profit after tax. You need to calculate preference dividend. You need to calculate EPS. You need to calculate MPS. PE ratio is there. What should be prepared so that we can get all the answers from that one thing? Income statement. If we are able to prepare the income statement, from there we will get all the figures, right? So what we will do here is we will prepare the income statement for all the three plans. Now income statement will start from where? Income statement will start from EBIT. So the first thing we have to calculate is what will be your EBIT, and what is given regarding EBIT? They say EBIT is 12% of capital employed. Now how much will be the capital employed? 1 crore of existing capital plus 25 lakhs of new capital that is to be raised, because when we are evaluating the different plans, what we need? We need EBIT after expansion, right? So it will be 12% of this. This will come to 15 lakhs. So EBIT will be your 15 lakhs. Now we will prepare the income statement under the three alternatives, right? Alternative 1 is what? The alternative 1 is your equity alternative. Second one is preference and third one is debt. Fine, sir. We are going to start with what? We are going to start with EBIT. And EBIT will remain same. Whichever plan you choose, the EBIT will not change. It will remain 15 lakhs. Under the preference also 15 lakhs, and under the debt also it is going to be 15 lakhs. From EBIT, what will you subtract? You will subtract your interest on debt. Interest on debt. Now, interest on debt, please be very careful with the interest on debt. Will there be any interest on debt in the equity option? Will there be any interest on debt in the equity option? Think about it very, very carefully. Think about it very, very carefully. You will say, no, sir, the interest on debt will only be in the debt option. But I am saying the interest on debt will be there in the equity option also. How is it possible, sir? In the equity option, how is it possible? It is possible. Why? Because there is this existing debt of 7% which is there. This existing debt, the interest on existing debt, you please do not forget to take it, right? So interest on debt will take on the existing debt. What will be your interest? That will be 7% on 25 lakhs. So existing will be 7% on 25 lakhs. So 25 lakhs, 7% will be 1,75,000. 1,75,000. Here also 1,75,000 and here also 1,75,000. right? Then new debt. Now in case of new debt, what is given, that you the percentage is 8% of 25 lakhs. It is 8% of 25 lakhs, but under which option? Now it will be under the debt option only, that is 2 lakh rupees. So it will be under this debt option only. So this is where you have to be very, very careful, that please do not forget to take the interest on the existing debt. That is to be taken for the calculation. So from here, what you will get, EBIT minus interest, you will get your EBT. That will be 13,25,000. In the preference option also 13,25,000. And here it will be 11,25,000. So from EBT, what you will pay? You will pay your taxes, and the tax rate is given as 50%. Right? So 13,25,000, 50% tax rate will be 6,62,500. Second case also 6,62,500, and 11,25,000, 50% tax rate is 5,62,500. Clear? So from here, what you will get your PAT, that is EAT or EAT, earnings after taxes or profits after taxes. So 50% tax was there, so 50% will be your profit, 6,62,500. Last case, 5,62,500. Is that clear, everyone? Now what you should be doing from here? From here, you will have to subtract your preference dividend. From here, you will subtract what? Preference dividend. Again, in preference dividend, will there be any preference dividend in the equity option? You will say, no sir, the preference dividend will only be in the preference share option. Again, you will be wrong. Why? Because there is the existing preference share capital also, on which the dividend is to be taken, 9% of 25 lakhs. So again, the existing part you have to take. Preference dividend, existing is how much? 9% of 25 lakhs. That comes to 2,25,000. So it will be under all the options. 2,25,000, 2,25,000 and 2,25,000, because the existing capital we will not ignore. Right? So on the existing preference shares, we have taken the dividend, and then for the new we have to take what is the rate of dividend on the new preference shares, that is given as 10%. So we'll take 10% of 25 lakhs. 10% of 25 lakhs. Now this new one will be only and only under the preference shares. After this, profit after taxes minus preference dividend will give you what? The residual earnings, or the earnings available for equity shareholders. This will be your residual earnings now. Right? That is 6,62,500 minus 2,25,000. That comes to 4,37,500. Next one is 1,87,500. And this one is 3,37,500. This is the residual earnings, or we can say the earnings which are available for equity shareholders. Now to calculate EPS, what will you do? To calculate the EPS, you will divide this residual earnings by number of equity shares. So divided by number of shares. In the first option, first is equity option. What will be the number of shares? See here very carefully. What is the existing number of shares that you have? 40,000 shares. In the first option, how many additional shares you will be issuing? That is 20,000 shares. So total number of shares in the first option will be 60,000. And in the second and third option, what will be the number of shares? In the first option, it will be 60,000. In the second and third option, it will be 40,000. That is the existing number of shares that you have. So from here, you will get your EPS. That comes to 7.29. Then we have 1,87,500 divided by 40,000. So that comes to 4.69, and 3,37,500 divided by 40,000, that comes to 8.44. I'm rounding it off to 2 decimals, right? Now, next, see this here. If we want to calculate the market price, how can we calculate the market price? Sir, PE ratio is given 20, 17 and 16. So what is given to you is PE ratio. PE ratio. So PE ratio is given as 20, 17 and 16. So how can we calculate the market price of the share? The market price of the share will be earnings per share multiplied by PE ratio. Right? So that will be 7.29 multiplied by 20, that comes to 145.8. Then it is 4.69 multiplied by 17, that comes to 79.73. And last one is 8.44 multiplied by 16, that comes to 135.04. Right, so this is the complete income statement that we have prepared right from EBIT till the calculation of MPS. Now we'll see what are the MCQs they are asking. They say calculate the profit after tax under the 3 plans. What will be the profit after tax? This is your profit after tax. 6,62,000, 6,62,000 and 5,62,500. So let's see which option is this. Option D. Clear? What will be the amount of the preference dividend under the 3 plans? Let's see amount of preference dividend here. The amount of preference dividend will be sum total of this two. So it will be 2,25,000, 4,75,000 and 2,25,000. So which option? This is option C, 2,25,000, 4,75,000 and 2,25,000. Please mark the options very carefully according to what is required. After that, what will be the amount of the earnings available for equity shareholders? Earnings available for equity shareholder means what? The residual earnings. 4,37,500, 187,500 and 337. Again, you have option C. Next one they are asking is what will be the EPS under the 3 plans? What is the EPS? We have already calculated the EPS under 3 plans. 7.29, 4.69 and 8.44. Again option C. Okay, option C, option C, option C. See, option C. So what will be the market price of the share? C, option C. Market price 145.8, 79.73 and 135.04. So 145.8. Okay, so finally we have got some other option, that is option B. So with this, the case study on capital structure is done. See, from the question itself, sometimes you will have to apply some extra brains, that what should be done, that from a single statement you prepared just one statement, and from that statement you are able to solve all the MCQs. Right? So the case studies are not difficult. The only thing is you just need a little bit of a practice on the case studies. That's it. The case studies is nothing difficult or nothing separate from what is the practical problem. The practical problem, put it in the form of a case study. But there you have to apply some extra brains, that how to solve it as quickly as possible. There the formats doesn't matter. In the case study, please do not go after the formats and all, because ultimately what matters is what you are going to circle the answer. That is going to on the OMR sheet, that is going to matter the most, right? So with this, the case study on capital structure is also done. Okay, so now we are going to discuss about the case scenario on dividend decisions. Very easy chapter, and this case scenario is what? This case scenario is similar to one of the practical problems that you have already done, but still I will explain, I will tell you how to deal with this kind of the problems, and this is a very important from the practical question also, because ICAI has already asked a practical question, a similar practical question. So this one is similar to your which one? Practical problem 5. This case study, if I talk about, it is what we can say, it is similar to problem 5, right? Your practical problem 5. Let's see. KGF Chemicals Limited, a prominent player in the chemical industry, faces the challenge of determining its growth trajectory and dividend policy to maximize the shareholder value. With the expectations of significant growth in the near term and stabilization in the long run, the company must strategically manage its resources to align with the investor expectations. Again, nothing as such relevant. KGF Chemical is a leading manufacturer and supplier of specialty chemicals catering to the diverse industries such as pharmaceuticals, agriculture and manufacturing. Established with a commitment to innovation and quality, the company has generated a strong market presence over the years. Again, something, the history about the company only, nothing relevant from the dividend point of view as such. The company is projected to experience a robust growth rate of 14% per annum for the next 4 years. So for 4 years, every year they are expecting that their growth rate will be 14%. Now this is a relevant information for us. Subsequently, the growth rate is expected to stabilize at the national economy's rate of 7% indefinitely. For the first 4 years, the growth rate will be 14% every year, and after that the rate will stabilize at 7% for indefinite period. There is no specific period which is given. This forecast reflects both the company's expansion plans and the broader economic landscape. The KGF Chemicals has paid a dividend of 2 per share, that is D0 is equal to 2. Now even this information, if information is not given to you in the examination, I told you paid a dividend means it is a D0. Had it been written expected dividend, then it is a D1. If it is paid a dividend, that means it is your D0. The management faces the crucial decision of balancing the dividend payouts with the reinvestment opportunities to sustain growth and meet the shareholders' expectation. The dividend policy must strike a delicate balance between rewarding the shareholders and retaining the earnings for future investment. Okay. The required rate of return on equity shares is 12%. So this is what? This is the KE that is given to you, indicating the investors' expected return given the company's risk profile and market conditions. The management must carefully assess the investment opportunities to ensure that they meet or exceed this threshold, thereby generating the value for shareholders over the long term. In navigating the dynamic landscape of the chemical industry, KGF Chemicals must adopt a proactive approach to managing the growth and dividend policy. By aligning the strategic decisions with the investor expectations and market dynamics, the company can position itself for the sustainable success while maximizing the shareholder value. Continual evaluation and adaptation will be essential to capitalize on the growth opportunities and maintain the competitiveness in the evolving marketplace. All a story. All a story. Nothing as such relevant from the dividends point of view. Right? So what is relevant from the dividend point of view? One, this KE is relevant, that 12% is your KE. Another thing, this growth part is important and D0 is important. Let's see what they're asking for. He says, what is the expected dividend at the end of 4th year? Now this similar we have done in the practical problem 5, right? In our course we have already done that. Okay, so how it is to be dealt with? See here, first 4 years, 1, 2, 3 and 4th year, right? So this is 0 period, this is first period, second period, third period and 4th period. In this period, every year they are expecting a growth rate of 14%. 14% here, 14% here and 14% every year the growth rate. After that, the growth rate for an indefinite period is going to be 7%. So how to deal with this kind of things? What they are asking for is the value of, okay, the first they are asking for expected dividend at the end of 4th year. So what is the dividend paid already? That is D0. Here it is given D0 is equal to 2. So what will be the dividend at the end of the first year? 2 plus 14%, that comes to 2.28. Here it will be 2.28. This will be your D1. Then plus 14%, that will come to 2.5992. This will be your D2 plus 14%. This will be your 2.963. Right? This will be your D3 plus 14%. That will be your 3.3779. 3.3779. This will be your D4. That is the value of dividend at the end of the 4th year. Let's see what is the nearest value that we have. Yes, 3.3779. Clear? What I did is nothing. The D0 is given to you. I applied the growth rate of 14% for every year. Year 1 14% on 2 rupees. Then year 2, year 3, year 4. Every year there is going to be a growth rate of 14%. Fine, sir. Done with this. Second part, what is the present value of the expected dividends to be received in the next 4 years? What they are saying is, what is the present value of these dividends? These dividends, what is the present value of what? Present value of these dividends multiplied by this, multiplied by, and what will be the discounting rate here now? The discounting rate will be your KE. KE will be your discounting rate. That is 12%. So what will be the present value factors? 1 divided by 1.12, 0.893, 0.797, then we have 0.712, and the next one we have is 0.636. So let's try to find out 2.28 multiplied by 0.893, that comes to 2.036, right? I'll take it to 3 decimals, so we will get the approximate answer, right? Multiplied by 0.797, that comes to 2.072, right? Then 2.963 multiplied by 0.712, that comes to 2.109. 965, that's fine. So 3.3779 multiplied by 0.636, that comes to 2.148. Now I'll take the total of this, 2.036 plus 2.072 plus 2.109 plus 2.148. So that comes to approximately 8.365. Let's see if we have some nearest answer. 8.3655, that is option B for us, right? So they were asking for the present value of the future dividends, the discounting rate being what? The discounting rate will be your KE, that is the cost of equity, that is 12%, which is given in the question itself. Now he says determine the market price of the share at the end of the year 4. That means what you need to calculate now here at the end of year 4, you have to calculate what? P4. How can you calculate P4 now? How do we calculate P0? P0 we calculate as D1 divided by KE minus growth rate, right? So for a 0 value, what is the dividend that we take? Dividend of the next year, that is at the end of the year. So here if you want to calculate P4, which dividend will you take? The dividend will be at the end of the year, that is D5. So dividend here we will take is D5, right? So we'll take D5 divided by KE minus G. Can I write D5 as D4? Because D5 I do not have, or I can have also, but I can write D4 into 1 plus growth rate divided by KE minus G, right? So D4 we have already calculated, that is 3.3779. 3.3779. growth rate is given to you. What is the growth rate now? 14% or 7%? What growth rate will you take? Sir, the growth rate you will take is 7%, because we are talking about this period now, right? Because after the 4th year, the growth rate on this 3.3779, what will be the growth that you will get? You will not get 14% growth rate, you will get 7% growth rate. So here you will take 7%, 0.007 divided by KE is given 12% minus growth rate of 0.07, right? So what will be the answer? Let's say 3.3779 plus 7% growth rate divided by 0.05. So that comes to 72.28 or 29. That comes to 72.287. Right, so this is the value that we are getting, 72.28. Correct, sir? This is the market price of the share at the end of the 4th year. Fine, got it? Next, determine the present value of this market price. Now he says calculate what? The present value of this market price. How will you calculate the present value of this market price? Multiplied by which present value factor will you take? Of the 5th year or 4th year? This is the price at the end of the 4th year. So the present value factor that you will take is for the 4th year, that is 0.636. So multiplied by 0.636, 72.287 multiplied by 0.636, that comes to approximately 45 point. So that comes to how much? That comes to 45.9 45.975. Let's see what is the answer that we have. That comes to 45.79. 45.79 or 97. Fine, sir. Due to decimals only there is a difference. Right? Now calculate the today's market price of the share. Today's market price of the share means what? You have to calculate P0. Right? You have to calculate what? You have to calculate P0. So what will be the P0 now here? The P0 will be the sum total of this present value, right, that we calculated as 8.365. Yes, that was the answer that we calculated, 8.365 plus the present value of this 45.79. So it will be 8.365 plus 45.79. 8.365 plus 45.79, that comes to 54.155. 54.33, I think that is the nearest answer that we have. 54.33. Let me check once. Let me check once what they have taken. Yes, 54.33, that is the nearest answer. 45.97, that is also the nearest answer. So that's it for the dividend decisions case study. An easy one, but this question is very, very important. So practical problem 5 also mark it as very, very important, right? Here when the growth rate, I'll tell you one more logic here. When the growth rate is constant, only then we can apply the Gordon's growth model. If you remember, Gordon's growth model. Now this is applicable only if the growth rate is constant. So in the first 4 years we cannot apply the growth rate, but from 4th year onwards, when the growth rate stabilizes at 7%, it is going to remain same for the rest of the period for indefinite life. So we cannot calculate for every year dividends, we cannot calculate, right? What we can calculate is P4. Now this P4 will take up all the, P4 is what? The price at the end of 4th year will be what? It is the present value of all the future dividends. This represents what? This represents the present value. This represents present value of all future dividends. Right? So we calculated P4 because we cannot calculate the individual dividends of each and every year. Right? So this is how it is being done. With this, the dividend decision case study is over. Please go through with this case study thoroughly, properly, with all the calculations and all I have done. So once I want you people to do it with all the calculations, and along with this case study, do practical problem 5 because it is similar to that, right? So with this, dividend decisions is done.